For the past 100 years, these are the 5 things that would normally happen right before the market crashes. And the first indicator, this is called the US Buffett indicator. So you can just go to this website, macro, micro, and then you'll see the Buffett indicator, which is this blue line over here, compared to the S&P 500. Now, what is the Buffett indicator? To put in simple terms, it compares the market cap to the GDP. Now, don't need to care too much about the definition and all that, but if you look at the past 30 years, okay, when are the major crashes? The first one, remember the dot-com crash, okay? Dot-com crash, you can see that our Buffett indicator went above 100. In fact, it went all the way to 123.12. So a lot of people are buying tech stocks, right? At that point in time, almost every tech stock you pick is profitable. Even a monkey can pick a profitable stock. So it's kind of similar to what's happening to AI stocks right now. So as the Buffett indicator goes above 100, you can see it crash right after 132, around there, okay? If you watch my market correlation videos, intermarket analysis, you know how useful is this, okay? You realize that Buffett indicator and S&P 500, it is very strongly positively correlated to each other. All right, I've taught you this already. And you can see that again, when is the next crash? The next crash is the housing market bubble, when all the way above 100. In fact, slightly lower than 2000 levels, all the way to 105.82. Just when everybody is super optimistic, buying tons of houses, even your taxi driver uncle is buying houses, even though he's not credit worthy, everything crashes. Okay? And again, when is the next crash? I don't think this time is going to come anymore. Hopefully it doesn't, okay? At around February, it went above 160.15. By now, you already know the clue. When it goes above 100, gotta be careful, okay? So right now, as of the making of this video, it is September. It is 215.7. Now, the thing is, of course, levels are going to go higher and higher since it is positively correlated to S&P 500, and the S&P 500 goes up in the long term. It will take way more than 100 for the markets to crash. The S&P 500 is going to go up along with Buffett indicator. But this is telling us that, okay, we are at the quite a very dangerous level. The risk to reward if you go in wouldn't be as good as compared to if you are to buy during a market crash. Now, the next ratio that's going to determine whether the market is going to crash is the Shiller PE ratio. Now, you can just go to this website. It's free again. Now, this is all the way back to more than 100 years. And look at this major crash over here. What is this? This is the Great Depression. Or some people call it the Black Thursday, but basically it's a major Wall Street crash. And you can see that our Shiller PE ratio is all the way up to 31.48. Then what's happening here again? This is the post-New Deal recession. A lot of people don't know about this, but it's not a big of a crash. So it's at 21.5. But a lot of people would know, definitely know or recall the dot-com crash, which I mentioned just now. You can see that in 1999, November, end of the year, it went all the way up to 43.21. This is crazily dangerous because if you look at the post-World War crash, you already know that, okay, we are at a very dangerous level. And yet a lot of people are buying because fear of missing out. Oh, everybody's making money in stocks, so let me just buy. And the next one, housing bubble, went up to 27.32, which is still okay, and then it crashed. Okay, so you can realize that this P ratio just correlates positively with all the crashes, even all the minor crashes. Like 1973, this is the oil embargo crash. Okay, 1946, the post World War II crash. Okay, and as of the making of this video, it is September, right? It is at 39.24, which is way higher than the housing market bubble crash at 27.32. And it's almost chasing up to the tech bubble. Right now, it is the AI bubble. I wouldn't be surprised if it goes beyond the tech bubble, and people are still not going to learn from it. Okay, because this time is different, which is the most expensive sentence in the world. Just understand that it is at a dangerously high level right now. Okay. But with that said, there are several indicators later on that shows you, hey, you know what? The crash might not be coming so soon just yet. So before you go to your portfolio and sell or short sell right now, you gotta look at the final few indicators. Okay. So my point is that Shiller PE ratio, anything above 30, kinda dangerous. Kinda dangerous. But of course, nothing is guaranteed. Things might change in the future. Okay, let's not do the this time is different mindset. Okay, let's move on to the next indicator. And this is again from Macro Micro website. Now this website is kind of cool. Okay, Finra margin depth. Finra margin depth. Okay, so when you come down here, you just gotta click on all so they can study the past 20, 30 years. Okay, now the red line over here, it is your S&P 500, alright? And the blue bars that you see over here are the Finra margin statistics. Basically, it just tells you how much money are people borrowing from brokers to buy stocks on margin. Now, if you trade stocks, invest in stocks, you know that buying on margin is one of the most dangerous things you can do. Okay? Because you're buying with money you don't have. And basically, Finra is the authority that tracks how much are brokers lending out money for investors to buy securities, which means that the higher this blue bar goes, the more people are borrowing to buy various asset classes, not just stocks. Because you can see in 2000, okay, during the tech bubble, a lot of people are buying money, borrowing money to buy stocks. So goes up in the tech bubble, goes up during the housing market bubble. See that? Again, goes up. And as of the making of this video, it is the highest ever possible. Now, even July, it was reported that the FINRA margin debt, it is at $1.02 trillion, highest ever. So let's move on to the next indicator. Remember when I told you just now, there's a few indicators that tell you, okay, the market is not going to crash just yet because people are not super greedy yet. All right. This is what I've taught you in my past global macro trading videos and also seminar recordings. Typically, you have four types of yield curves: the steep yield curve, normal yield curve, flat inverted yield curve. Now, I don't need to care about, okay, long-term bonds, short-term bonds for now. I just want you to understand the shape and what does it mean. Typically, for a steep yield curve, people are anticipating that the economy is going to pick up in the near future. But at the same time, they are also worried that inflation is going to go out of control. So basically, they feel that the economy is going to improve in the near future. Whereas for an inverted yield curve, this is normally what happens before a market crashes for the past 100 years. But an inverted yield curve doesn't always lead to a market crash. You got to understand the difference. And an inverted yield curve normally happens when the short-term rates are higher than the long-term rates. So as of right now, you can go to this website called slickcharts.com/treasury. You can come here to check the yields of the short-term bonds, comparing it to the yields of the long-term bonds. Now, it is summarized in simple terms in this graph over here. Just by looking at this, you can tell long-term yields are higher than short-term yields. So it's a steepening yield curve. So it means that people still expect that the economy is going to expand in the near future. So this decreases the probability that, okay, a major market crash is going to come. Even if the stock market does go down, it would give you a correction, a slight drawdown, retracement, but not so much of a stock market major crash. Okay. And you can also look at this website. This is one of my favorites too, because it is stated very clearly. These are the bonds, and then these are the bills. And then it also shows you the current price. Okay. It also shows you the current price. And also compares it with the yield curve 1 year ago. You can use this website. In fact, last year, there was a slight inverted yield curve, right? The short-term bonds being higher than the long-term bond rates. So if you see something like this, you gotta take note and be careful. But like I said just now, doesn't mean that when you see an inverted yield curve, then a stock market crash is going to come. There's a 60-70% chance, but not 100% chance. And when you see a steepening yield curve, it also tells you that investors would expect that interest rates are going to go up in the near future, as well as inflation. So they are going to be concerned about inflation for now. So to put in simple terms, when you see everybody in the streets, even non-traders, non-investors jumping to the stock market, buying meme stocks, buying meme coins, then you know that, okay, people are starting to get greedy and the market is about to crash. This happens almost all the time in the past, many market bubbles. When it seems like every single person on social media is making money easily without doing much work, you already know. Stay tuned for more market analysis updates. And I'll talk to you in the next video. Bye.